Very good morning to all. Kelvin here again. I hope that you all have a great and wonderful and most importantly restful weekend. Good morning. Welcome to a brand new trading week. Today will be the Monday, the 8th of September 2025. So as usual, before we jump straight into the gist of our daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so let's kickstart with what has taken shape on last Friday, over the weekend, and as well as in today's early Asia session before the start of our daily dose, which is at 11 a.m. Singapore time. The relevant economic data, releases, news flow, and their respective impact on the intraday movement on the broad-based cross-asset classes that we cover on a daily basis. That is, i.e., the major US dollar pair, the major US stock indices for sure, and as well as the other major stock indices ranging from the Asia all the way up to Europe, and the two key commodities market, which is gold XAU/USD and West Texas crude oil. So let's start with the all important release of the US Tier 1 labor market data on last Friday, which was the US non-farm payroll and the unemployment rate for the month of August. So let me make sure that my screen is okay. Yeah, I think the screen is showing good. Okay, so let us take a look at this important Tier 1 US economic data that was released on last Friday. So it came in way below market expectation. So it came in at 75 22K. Market was expecting 75K job added. It came in way below market expected at 22K jobs added, which is a very low ball number. And also the unemployment rate continued to tick higher from the previous month, July month of 4.2. It ticked higher to 4.3%, within market expectation of 4.3 over here. So what market view is over here is right now the US labor market has indeed starts to turn soft, and most importantly, in the last 3 to 4 months, the Fed has been rather late in responding to this ongoing weakening of the US labor market. That means, i.e., potentially they got to do more now to kickstart their interest rate cut cycle. And bearing in mind, so far in the last cut that the Fed undergo, that was in last year 2025 December. So right now, throughout the last 7 to 8 months, the Fed has been pretty much on the whole, indicating risks of uncertainty due to the White House administration tariffs policy. But right now, the way of the softness of the US labor market has now taken over the uncertainty part surrounding the US tariff policy that could potentially allow inflation trend to remain much more sticky above the Fed desired long-term target of 2%. So what you could see over here is the CME Fed Watch 2 has now indicate a small little chance that the Fed may do more this coming FOMC meeting, which is on the 17th of September. A quick recap. So far, the Fed funds rate is at 4.25% to 4.5% that I mentioned earlier last week. Market has almost priced in fully 100% that the Fed will potentially cut by 25 basis points to bring the Fed funds rate down to 4% to 4.25%. And what's interesting over here is that it's still 100% now. Why? Because there's a probability. There's how probability works is there's a split. 90% based on the Fed funds futures traders trading behavior as being compiled by the CME Fed Watch 2 indicate 90% chance, 25 basis point cut to 4% to 4.25%. Then right now there is a 10% chance that the Fed funds futures traders has started to price in, not really that great 10%, but this 10% was not being seen before the release of the non-farm payroll data. So this 10% suddenly came in that there is a small chance right now that the Fed may do more on 17th of September. That means, i.e., a 50 basis point cut to bring down much lower to 3.75% to 4%. And that actually impacted the FX market as per se. Why? Because the yield the most sensitive US Treasury fixed income, which is the 2-year Treasury note yield, testing 1, 2, 3. So I think it should be fine right now. All right, great. My apologies about that. There's some technical glitch. Sometimes, this kind of go to webinar. Sometimes I don't know what. All right. So now let us go back to what I was inferring to earlier. Is the rather sudden so-called 10% chance that the Fed may do more on the 17th of September by cutting 50 basis points. That led to a plunge in this US 2-year Treasury yield. And this US 2-year Treasury is very important because it's very sensitive to monetary policy stances change by the US Federal Reserve. So what I could see is that on last Friday, it broke below a key support level at 3.55%, and it traded at 3.52. Why this 3.55% is very important? If I were to go to the weekly chart, okay, you see this 3.55 has been a key major support of the 2-year Treasury yield. So this is a weekly chart. I'll just change to weekly since the low of 20th of March week of 2023. So that is actually a 2-year-old of support. So on last week, it has a weekly close below this major 2-year support level at 3.55, indicating that further softness may prevail on the 2-year Treasury yield, inching downwards lower, leading to that yield premium of the 2-year Treasury yield against the rest of the world to be getting lesser and lesser. That means from a yield perspective, US Treasury, short-term US Treasury like the 2-year is less attractive compared to the rest of the world, thereby putting downside pressure on the US dollar that we have already expected. In my daily dose, I shared with you guys earlier last week and even 2 weeks before, and also before the release of the US non-farm payroll data, because from a technical perspective, irregardless of whatever bounce that we see on the US dollar index 2 to 3 weeks ago is only a corrective rebound. We in a potential ongoing major downtrend phase in the US dollar index. So let us share with you the daily chart of the US dollar index. So what I could see over here is ever since it can't properly break above 98.95 over here, this is 8.95. There's actually 2 key risk events. The 1st of August is the release of that so-called the previous non-farm payroll print that is rather weak, and this initial sell-off earlier on 22nd of August is the change of tonality from Fed Chair Powell speech over in the Jackson Hole Symposium, where he suddenly switched to a much more dovish tone, and thereafter price action just traded sideways. And on Friday, it actually has a daily close below the 20-day and the 50-day moving average. And right now, looking to eye the 97.30 key support level on the US dollar index. 97.30, why is it key? Very quickly, I go to the monthly chart. So what you can see on the monthly chart is the lower boundary of this ongoing circular ascending channel support that has been in place since May 2011 low. And given the fact that the 2-year Treasury yield has already broken a major support of 3.55%, which I shared with you earlier on over here, and that could be a pre-signal for the US dollar index to potentially break below 97.3. Okay, so something to look out for going forward this week as well, because this week we have another key risk event that is taking shape, which is the release of the US core CPI data out on Thursday, And also on Friday, we have the Tier 1 consumer confidence data compiled by the University of Michigan. That is on Friday. Okay, key risk event as well, as the US dollar index approaches a key support level at 97.3. So what I could see very quickly, the major US dollar pair continues to remain lackluster over here in today's. Okay, so this is the 5-day rolling performance. Over here, the release of that normal payroll data, you see a steep plunge. Then after that, during the US session, it managed to bounce a bit. And right now, as we are speaking right now, this is a 5-day rolling performance. If I switch down to a lower time frame on the 1-day rolling performance, taking into account of the start of today's Asia session, okay, we see the dollar pair against the rest of other major currency continues to remain lackluster. That means the dollar against Sing, the dollar against Swiss, the dollar against Euro, the dollar against sterling, and the weakest now is the dollar is against the Aussie and the dollar against Kiwi, where the dollar is showing negative 0.8%. The dollar is losing against the Kiwi by negative 0.8%, similar pace of against the dollar Aussie as well. And what's interesting over here is that, you know, this dark blue line, this earlier spike up of around 0.7%. So there was a gap up in the dollar yen to go up, to go slightly above 148 figure level, but it can't break above the 148.15, the 200-day moving average. Later I'll share with you the short-term technical chart of the dollar yen. And even the dollar yen, this earlier morning spike up is due to a key risk event, localized event that takes shape on Japan on Sunday. Later I'll show you what is it. And can't maintain the momentum, and the dollar yen starts to goes down lower. So in anticipation of a much more dovish Fed in relation with BOJ policy that could potentially be impacted by a localized Japanese event that takes shape on Sunday. Later I'll show you what is this event. Over to the stock market. All right, so the US stock market, like I mentioned earlier on my data on last Friday, be aware of a potential pullback because the US stock market has rallied ahead of the release of the November payroll data and hitting some short-term respective resistance level that I mentioned in my daily dose on Friday, which is the daily dose that I covered on the US Wall Street 30 index, which is the representative of the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100. And indeed, the US stock market faces that so-called a jinx of once actual news release event has released, there's this sell the news so-called behavior that takes shape. Yes, the US market did that pullback, and the pullback stopped exactly at our short-term pivotal support level at or very close to it before doing a slight recovery in the rest of the US session on last Friday. And what's interesting over here is that as we are speaking right now, the E-mini futures that is trading right now during Asia session, that means i.e. the E-mini futures of the S&P 500 and the Nasdaq 100 managed to continues to their bounces. The S&P E-mini future is up 0.10% over here, a strong push up in today's Asia session, followed by the Nasdaq 100 E-mini futures, which is up by 0.3%. So later I'll show you what are the key levels to watch on the short-term chart on these three major US stock indices that we cover on a frequent basis, inclusive of the US Wall Street 30, which is representing the Dow Jones Industrial Average over here. And also, given the fact that we now start to see a much more higher chance that the Fed may do 3 cuts before 2025 ends. How do I have a gauge on that? By looking at the CME Fed Watch 2 again, but this time around, don't look at the current tab, we look at the aggregated tab, which allow us to have a gauge of the probability being assigned by the Fed Funds futures traders across all the meeting until 9th of December 2026. So that's the beauty of the CME Fed Watch 2. And it's free, but it's not, the data is not live. It's there's a slight delay, about one hour plus, but which is good enough for us to have a gauge of what the market participants are assigning odds and probability, and from there we could adjust our risk management perspective and our trading strategy over here. So let me share with you why do I mean by this. Okay, so right now high chance 25 basis point has already been baked in the upcoming 17th of September. But how about the next 2 meetings before the year's end, which is on the 29th of October and the 10th of December 2025. So right now, there is 2 chance and a high chance of more than 50% that the Fed may do 3 cuts in 2025. How do I read that? 29th of October, potentially the Fed have a 87% chance that they may cut to bring it down much lower to 3.75% to 4%, at a high chance also of more than 60% of 75.6, 76% approximately, to bring it down further to 3.5% to 3.75%. So that is actually a potential implied 3 interest rate cut before 2025 ends, to bring the Fed funds rate down to 3.5% to 3.75% on the 10th of December 2025, which is the last FOMC meeting for this year. So initially, still recall that the dot plot that was released in June by the Fed, dot plot is where the Federal Reserve official do projection of what they view Fed funds rate will be in 2025 to 2026 and in the long term. So previously, they only pencil in potential 2 interest rate cut implied. So right now, market participants has been much more dovish by them, given the fact of the very, very weak non-farm payroll data, and as well as the unemployment rate that could tick up higher to 4.3%, and that allows the market participant to assign a higher probability that the Fed may do more in 2025. And also, very importantly, on the 17th of September FOMC meeting, the US Federal Reserve will release the new dot plot. So if this new dot plot came in within market expectation, where they start to pencil in 3 more interest rate cut for this year, or they start to pencil in more interest rate cut potentially for next year at 2025. So next year, market participant is expecting the Fed to bring down the Fed funds rate much lower to end 2026 2.7% to 3%. Right, so that is a very dovish pricing, and overall causes the US dollar to weaken. All right, over here. So over the weekend, there's this news about OPEC Plus as well. So OPEC Plus, I do mention that do keep a lookout that they may start to actually do production increase, not production hike. And prior to that production hike announcement over on Sunday, the West Texas crude oil on Friday came below. The West Texas crude oil on Friday actually plunges because of the weak non-farm payroll data over here, and hit this support level about 62.20, which is pretty much key, before staging a bounce right now in today's Asia session, but up by 0.9%. So there was a little bounce up by 0.9% because the OPEC Plus member, the cartel, didn't actually did a tremendous amount of production. We call it production increase. Okay, so what they did over here is that they, in principle, do agreement among the members to actually increase production by 137k barrels, 137k barrels per day increase from next month on October. Okay, so this amount is significantly smaller than the previous month heights of around 550k barrels per day in August and September, and the 411k barrels per day in June and July. So that led to a so-called a relief rally in the West Texas crude oil in today's Asia session, which is up by 0.9%. So later I'll share with you what is the new directional bias and the key levels to watch after last Friday bearish bias, where it really hit that support level at that 62.50, 62.20 levels on the West Texas crude oil over here. And what we could see over here is that due to lower US Treasury yield, that actually reduces gold opportunity cost for holding gold, and spot gold XAU/RA continues to rally and almost hit our resistance level that we mentioned on last Friday at 3,600 as expected. So later I'll share with you what are the key levels to watch out for today. All right, now back to one particular weekend news that I mentioned earlier that causes the dollar yen to actually spike up is due to this localized Japanese key risk news flow, where Japan current Prime Minister Ishiba, he actually informed that his party that he is willing to step down, all right, paving way for a new leader. So right now the key story over here is that this stepping down of the current Japanese PM has already been writing in the wall in the last 2 to 3 months after that rather weak performance of his party, LDP party, in the upper house election that was held recently. And the reason also previously he decided to hold on to his position because of that ongoing negotiation, the trade negotiation between Japan and US. And since that right now the Japan and US trade negotiation has ended, and formally US has assigned a lower trade tariff of 15% on almost all Japanese exports heading into the US, especially on Japan automobiles, which is very key exports to Japan, and also export that potentially has significant impact on Japan GDP growth. So that has already also been more or less confirmed at a 50% rate from the earlier higher tariff of sectoral tariff of 27% or so. So that being the case, he actually chose to step down. But what market participants now is actually concerned who will be taking over his position. So right now there is actually a forerunner within the party itself. We're going to vote for a that means, i.e., the party will vote who will step up and take over Japan's the current Japan's PM who has just resigned, Ishiba. And after that, this candidate will be actually voted in the Japanese parliament. So it's a two-step process. So right now, market participants is viewing this hardline conservative Takachi. So Takachi previously was second in running to Ishiba. So you recall that Ishiba was also being pushed up to the forefront when the previous his predecessor also currently suddenly forced to step down. So this lady Takachi, she is a very hardline conservative, and based on her public speeches over here, she is much more in favor of continuing of monetary policy easing and looser fiscal spending over here. So that causes a bit of fear on the FX market, particularly the dollar yen, and that could potentially interfere with Bank of Japan ongoing normalization monetary policy, where they're actually looking to gradually increase interest rate rather than cutting rates back to zero or negative again. All right, so that actually created that spike up in the dollar yen over here. But what's interesting is that spike up in the dollar yen can't break above a key resistance, which is the 200-day moving average. So later I'll highlight to you guys over here. All right, so that comes the first segment of today's daily dose. All right, so now let us move on to the second segment, which is the technical analysis outlook segment on the intraday basis. But before that, let me expand my screen. All right, over here. Yeah, hopefully everything is fine here. Okay, good. I think the screen got expanded. All right, let's start with the FX market. Okay, very quickly, this will be the euro dollar. So euro dollar on last Friday did that bullish breakout from that former medium-term descending trend line that was previously in place since 1st of July high. And this 1st July high is the current 52-week high of the euro dollar over here. Right, 1st of July, previously it kept previous rally on 24th of July. It also kept the rally on 22nd of July, which is a very important day. So this is the push-up where triggered by Fed Chair Dovi's speech over at the Jackson Hole Symposium. It can't break out on the 1st of September, which is the start of this new month, and thereafter it managed to finally do that bullish breakout after that weak non-farm payroll data. So what we could see is that right now there's a pullback, and this pullback now is forming a minor first support level right exactly at this former medium-term descending trend line now turns into a pullback support at the 170.30 level. So given that it has broken up above this former medium-term descending trend line that kept the boost in check since 1st of July, I will tighten my pivotal support for today at the 20-day moving average, and so very close to this ongoing minor ascending channel support from the low of 1st of August 2025, which is now at 116.65. So using a tightened short-term pivotal support for today at 116.65 on the euro dollar, still maintaining that bullish bias on the euro dollar, looking for that. Okay, so this is the euro dollar. So let me put it in. I don't know why it's got deleted. All right, so let me put it in writing so that you guys have a better visualization on the charts. All right, so this will be the euro dollar. Okay. Next resistance level to watch in the near term for today at 117.70/117.90. Above this level, potentially seek out the 1st of July minor swing high and also the current 52-week high at 118.30. Only a bearish breakdown below 116.65 will invalidate today's intraday bullish bias to see another round of a choppy minor corrective decline sequence, retesting the last Tuesday and last Wednesday minor swing low area at 116.17. So that's for the euro dollar. Very quickly will be the sterling dollar over here. So the sterling dollar push up, hit our first resistance but can't break above it at 135.45. So we will not want to actually be so aggressive to tighten my pivotal support, which I have from last Friday at 133.95. So there's one more lower level to watch, will be the minor swing high area of Wednesday and Thursday last week. Now turns into a minor pullback support at 134.50. So if we start to see an hourly close after the start of the European session today at 135.45, then I could tighten my pivotal support to 134.50. So for now, things still maintain the same for the pivotal support level, 133.95 as of Friday. As the same of Friday, pardon me, maintain that bullish bias on the sterling dollar. Next resistance level to watch will be at 135.90/136.10. Above it, we'll see the congestion area of 27th of June, 4th of July 2025 at 136.50, 136.80. Only a bearish breakdown below 133.95 will invalidate today's intraday bullish bias to kickstart another round of minor corrective decline sequence, retesting the medium-term ascending trend line that managed to survive during the onslaught of that push-up in the 30-year UK gilt, which is my pivotal support zone at 133.15, 132.80 on the sterling dollar. Next up, Aussie dollar. So the Aussie dollar continues to push higher and hit our resistance level at this 65.60, and right now managed to actually did a pullback very closely at 160 at 65.50 over here. All right, 65.50. So this is my level here. Okay, so first support level 65.45, Titan pivotal support for today will be at the 50-day moving average at 65.20, and so confluence with the lower limit of this ongoing minor ascending channel that I drew from the low of 22nd of August. Maintain that bullish bias maintain that bullish bias of the Aussie dollar as it continues to push higher within this medium-term expanding wedge configuration that is still in place since 24th of June. All right, so the next big support level to watch out for will be the next big resistance to watch out for will be 66.60/67. So that is from a multi-day perspective. We also confluence with the long-term circular descending trend line from 25th of February. Now, very immediately, let's go to the shorter term time frame again for what are the intraday resistance level to watch. First intraday resistance level 65.80, where it got tested on last Friday, where it did a pullback. Above this 65.80, potentially seek out higher intermediate resistance level at 66.05/66.20, which is a Fibo extension cluster level, and as well as the upper limit of this minor ascending channel, and also confluence with the minor swing high of 24th of July 2025, which is a rather important level. However, a bearish breakdown below 65.25 will invalidate today's bullish bias to see another round of choppy minor corrective decline sequence unfolding, retesting the 20-day moving average, which also confluence with the minor swing low of last Wednesday and last Friday before the release of last Thursday, pardon me, at 65 figure level before the release of the non-farm payroll data on last Friday. So that's for the Aussie dollar. Now back to the very interesting dollar yen over here. So dollar yen, what I could see is that this is a spike up in early today's Asia session. So on last Friday, we have a neutrality stance. So what I could see over here is that the spike up didn't actually surpass the 20-day moving average and also our upper limit of the neutrality stance we have on last Friday, which is 148.75, 148.95 over here. So it seems to us that right now the dollar yen is going to be trapped within a minor range configuration that has been in play since 22nd of August over here with the lower limit at 14670/40. So right now, since it's managed to have that bearish reaction of this upper limit of this range configuration, minor range configuration, I will flip to a bearish bias for it to potentially slide down to the middle part of this minor sideways range configuration. So pivotal resistance level will be this all significant range resistance, which and as well as confluencing with this downward sloping 200-day moving average, where the bulls also got rejected recently since 2nd of September, which is the start of this month. 148.75, 148.95 short-term pivotal support. Pardon me, I repeat again, 148.75, 148.95 short-term pivotal resistance. Bearish bias towards the middle part of the range, which is the gap up in today's Asia session, 149.90. broken down below it, potentially seek out the lower limit of the gap and so confluence with the 20-day moving average at 14750, 14730. Only a bullish breakout above 14895 will invalidate today's bearish bias to see a squeeze up towards 14970, 14980 next. So that's for the dollar yen. All right. Next up will be the major stock indices, starting with the Hong Kong 33 over here. So right now, the Hong Kong 33 now is attempting to actually do a breakout above the 25,490 level over here, 25,490 level. So with that, I will actually is actually showing some kind of positiveness at 25,490. So given that there's a strong minor V-shaped bounce that has taken shape on last Friday, which is at the 20-day moving average. So we will maintain that bullish bias on the Hong Kong 33 that is representing the Hang Seng index over here at 25,260, which is my short-term pivotal support level that I have for today, a Titan one. Next resistance level to watch will be the minor swing high of 26th of August, 2nd of September, and as well as 3rd of September, where previously we start to see a stubborn profit taking that has a stiff stubborn profit taking that has taken shape earlier on, which is at 25,690. So that is the two next resistance level to watch for today on the whole 33. However, if we start to see a bearish breakdown below 25,260, then today's intraday bullish bias will be negated to see another round of choppy minor corrective decline sequence unfolding to test the next support level over here, which is this minor gap up, okay, previously at 25,040. Right, below 25,040, potentially revisit the medium-term pivotal support level, which is also confluencing the rising 50-day moving average, and also quite in between, and also this and also very closely to the medium-term ascending channel from the low of 2nd of June 2025 low. 24,880 will be the next support level to watch if 25,070 gives way. Right, so that's for the Hong Kong 33. Up next will be the Japan 225, which represents the Nikkei 225. So the Japan 225 managed to gap up over here. So given the fact that the reason why Japan 225 went up because potentially the next incoming prime minister will be much more ambitious in terms of having a much more expansionary fiscal policy as compared to the previously PM Ishiba over here. So that causes the Japan 225 to actually push up potentially lower tax and as well as more subsidies that may come in play going forward. So from a technical perspective, the Japan 225 still remains bullish over here. So right now it's actually revisiting the current all-time high that has been printed on 18th of August, which is at 43,850. So yes, RSI has hit the overbought level over here. So right now it's attempting to exit from the overbought. So given this strong push up at this point in time, there could be a minor pullback taking shape, and then last Friday resistance level has also been met at the 43,200, then the 43,000 figure level. All this level has been taken up. So given the fact that this strong gap up in today's Asia session, leading the hourly RSI to be overbought, and right now there's an exit from the overbought on the hourly RSI, risk of a minor pullback first before the bullish momentum resumes. So yes, we still maintain that bullish bias on the intraday basis, but bear in mind there could be a pullback taking shape over here. So as long as this minor pullback managed to hold at this Titan short-term pivotal support zone that I have right now for today at 43,060, 42,850, which confluence with the gap up in today's Asia session and as well as the rising 20-day moving average. The next potential move on the Japan 225 will potentially shape another bullish up leg after this minor pullback has taken shape. Next resistance level to watch will be a Fibo extension level slightly above the current all-time high area of 18th of August at 44,050, 44,110 level. All right, above this level, potentially seek out 44,850 840, 44,970, which is also another FIBO extension level as well. Right. Lastly, next will be the Germany 30 representing the DAX. So the Germany 30 represent DAX continues to be rather choppy over here. So on last Friday, it did a sell-off, broken below that former minor swing high at 23,670, which is my short-term pivotal support level I have. Came down, then thereafter it managed to bounce a bit over here, right above the low of last Tuesday. All right, so given this choppy movement on the Germany 30, which is representing DAX, I will flip to a neutrality stance for today because of unclear configuration. A neutral between 23,900 and 23,490 for today on the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30, that's representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average on last Friday, during the release of the non-farm payroll data, it did a spike up. Then after that spike up, it can't maintain that momentum and starts to do that pullback, which came in within our expectation because we do highlight that there's a risk of a minor pullback taking shape. Still can't clear above the current all-time high area at 45,780. But what's interesting is that the pullback managed to hold up exactly at our pivotal support level, which is also confluence with the rising 20-day moving average, with a bit of excess on the intraday low at 175, which is the 20-day moving average. So for today, I will have a slight access below 45,290 slash 45,175. Still maintain that bullish bias on the US Wall Street 30. For sure, first resistance level to watch will be 45,780. Breakout above 45,780, potentially seek out 46,060, 46,180, which is also the FIBO extension cluster level. And if we will take into account of the latest minor impulsive up move sequence that has been taking shape since the low of last Tuesday, if we do a FIBO extension level based on the latest price action, it also confluence with the one-time FIBO extension as well, making this 46,060, 46,180 an important, significant near-term resistance level after 45,780. However, a bearish breakdown below 45,175 on the US Wall Street 30 index that will negate today's bullish bias to see a choppy corrective decline to retest last Tuesday minor swing low area at 45,945. Next up will be the SPX. So the SPX also very similar, hit the first resistance, can't maintain that momentum and push down and managed to help right exactly at our pivotal support that we highlighted on last Friday, which is also confluence with the rising 20-day moving average at 6,450. So no change, 6,450 short-term pivotal support level on the SPX 500. Maintain that bullish bias. First resistance level to watch 6,517, above it 6,556, 6,565, which is a FIBO extension cluster level. Only a bearish breakdown below 6,450 will negate today's bullish tone to see a deeper minor corrective decline extending further towards the downside to test 6,410, which is also confluence with the medium-term ascending channel that has been in place since 23rd of May 2025 low. Lastly will be the Nasdaq 100. So the Nasdaq 100 also managed to bounce off from our short-term pivotal support zone, 23,470, 23,385 that we highlighted earlier on last Friday to watch out for this minor pullback. So minor pullback did a minor V-shaped recovery. So for sure, I don't want to tighten my pivotal support level to be so tight for today. So I still maintain the same level at 23,470, 23,385. Short-term pivotal support zone, maintain that bullish bias on the Nasdaq 100. Next resistance level to watch will be the current all-time high area at 23,930. Above it, potentially seek out 24,050, which is the 1.382 FIBO extension from the low of the 20th of August, connected to the low of 3rd of September. Only a bearish breakdown below 23,385 would negate today's bullish bias to see another round of minor corrective decline sequence extending further to retest the 50-day moving average, which is converging as the next intermediate support level at 23,230. Very quickly, let's proceed now to the commodities market, starting with gold XAU/USD. So gold XAU/USD has hit our resistance level, 3,590, 3,600 level, which is a FIBO extension cluster level as well, and as well as a psychological level. Right now, the RSI has started to exit from the overbought level over here, has really exited from the overbought level. So there could be a risk of a minor pullback taking shape. So minor pullback could be hovering left at around the 3,563 level, which is the pullback first support level to watch. Maximum will be my Titan short-term pivotal support at 3,536, which is the minor congestion area of last Friday before that burst up upon the release, after the release of the non-farm payroll data. And if we do the Fibo retracement of this ongoing impulsive up move sequence from the low of 20th of August all the way up to today's last Friday intraday high, that also confluence with the 23.6% Fibo retracement level as well. So as long as this minor pullback didn't surpass below my Titan short-term pivotal support that I have for today at 3,536, maintain that bullish bias will go after this potential minor pullback has taken shape. Next resistance level to watch will be at 3,627, 3,631, which is a Fibo extension cluster level. However, a bearish breakdown below 6,536 potentially will see a much more pronounced minor corrective decline unfolding to retest the former all-time high at 3,500, which is the next intermediate support level to watch. And this 3,500 now also confluence with this minor ascending trend line that I drew from the low of 22nd of August. Lastly will be the West Texas crude oil over here. So the West Texas crude oil managed to hit the first support level at 62.50 before staging that bounce up for today. So given the fact that it really it has started to exit from the overbought level over here, exit out from the oversold level, pardon me, not overbought, it managed to exit out from the oversold level, but upon exiting out from the oversold level, there is no bearish divergence. So price action continues on the RSI, remains a lower low in line with the price action of the West Texas oil. So right now it's likely more to be a minor rebound phase to retest these two resistance level. First resistance level at 63.30, maximum will be the 20-day moving average, where it has been resisted since last Thursday, where price actions try to test on it, and also on Thursday, on the whole entire session of Thursday before plunging lower upon the release of that non-farm payroll data. So now this will be my key pivotal resistance level, a Titan one, 64.10. So as long as any of this minor bounce didn't surpass above 64.10, I will still maintain that bearish bias on the West Texas oil over here. So the next support level to watch in the intermediate term will be the minor swing low of last Friday over here at 61.85. All right, let me put it in writing, 61.85. 61.85. Come on. Okay, give me a couple of seconds for it to be allowed to write. All right, 61.85. Okay, a breakdown below 61.85 exposes the next near-term support level at 61.30, which is the 2nd of June 2025 gap up. Only a bullish breakout above 64.10 will invalidate today's bearish bias to see a much more steeper corrective rebound sequence unfolding to revisit the next intermediate resistance level at 65 figure level, which is the pullback line of this former minor ascending support from the low of 18th of August. All right, so that's for West Texas oil, and also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go very quickly, let's have a quick look at the economic calendar. What are the key data to look out for today during the start of the European session? So at 2 p.m. Singapore time, we do have Germany balance of trade data for July. So that could potentially influence the euro dollar, the euro crosses, and the Germany 30 CFD index. And also going forward, there is no insignificant important US data to take note of other than a tier 3 data, which is 11 p.m. Consumer inflation expectation. So that is not as important as this Friday University of Michigan poll data. So that's for the month of August. Out at 11 p.m. Singapore time, that may influence the major dollar pair and the major stock indices over here. And before the start of our daily dose tomorrow at Tuesday, 9 of September at 8:30 a.m. Singapore time, we have Australia Westpac consumer confidence data, followed by 9:30 a.m. tomorrow before the start of a daily dose at 11 a.m. NAB business confidence data for Australia as well. So these two confidence data may impact the Aussie dollar, the Aussie crosses, and as well as the the Australia 200 CFD index. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.